We're just going to talk today about 10 rules for passive investors. A lot of stuff has gone on over the last couple of years, and I feel like the game has changed, and I think for the better, quite frankly, for passive investors. I really think, well, for investors in general, and I think today, right now, is a really good time. It may not feel that way all the time, and sometimes I'm like, "Are you sure?" But I think overall, today is a really good time, and I don't quite liken it to the opportunities we saw during the GFC. But I think there certainly are opportunities out there available, and what I think is more important than maybe the distress or things like that. A lot of people want to see this distressed property that's amazing, and I don't. Those aren't necessarily out there that much. But what is out there, and I think this is going to be the thing that's going to really propel us, is that rent growth has been fairly stagnant while building is up, and that has caused a lot of strain on specifically multifamily owners. But a lot of the other asset classes, specifically real estate, have gone through some struggles. And I think there's opportunity in office. I think there's opportunity in multifamily. I think there's opportunity a little less so in industrial and in retail and so on. So I think there's quite a bit of opportunity out there. I don't necessarily think it's going to be that like, wow, this is exciting, amazing. Like, oh my gosh, I can't believe it. But I do think that those who are prudent are going to win pretty nicely over the next handful of years. And I think if you're investing either actively or passively, if you're in the game, I think you're going to do well. Real quick, Endurus Capital, we own about just over a half a million in real estate that we've owned. Currently, we actually have a little bit less through sales and stuff like that. So we currently own about 2,500 units of multifamily. And got some assisted living and retail, industrial, things like that. But bread and butter is always been multifamily. Um, all right, we're going to be talking about passive investing a lot, but this also pertains to active investing. So everything I talk about today is going to pertain both to active and passive. I'm going to probably relate it to mostly to passive investing, but again, it's the same. Like the rules are going to be pretty much the same, and there might be some slight variations and twists on it. Like when I talk about what to look for as a passive investor, a lot of that same stuff as you're going to be looking for as an active investor, or you should be doing well as an active investor. Like when I talk about what a sponsor should be doing, you should be doing that as an active investor yourself. When I'm going to be talking about reporting, you should be knowing exactly what your property is doing and how it's operating and communicating. Like, yeah, maybe you don't have to communicate to investors, but you have to communicate to yourself, because if you don't know what's going on with your property, you're not going to be successful. One of the things I think that being me doing syndications, me um, putting deals out there to investors has made me a better investor myself. It's made me better at purchasing properties. It's made me better at underwriting properties. It's made me better at communicating and understanding exactly what's going on with my properties, because I'm held accountable now to, whatever, 100, 200, 300 investors that are in the deal. And, we have, I think, over 500 investors total. And so they're holding me accountable, and I have to know what's going on with those properties, and I have to report properly. And so it's made me a lot better operator and an owner of real estate in general. So, all right. So syndication real quick, just most of you know, because you're on this. And so you probably know what it is, but I'm going to go through it real quick and then we'll go on. So pooling money together to buy a piece of real estate, a business, any other alternative asset is as simple as it is. And so there's limited partners. Those are the investors. And then there's the general partner who is running the deal, brought the deal, running the deal, all that kind of stuff. LP risk is the money, hopefully, as long as you are in the, by the way, that's actually, I should asterisk that. Like there are some deals where you might sign on the debt where you might be doing more than just your money at risk. So understand that. But then you usually get a slice of the profit, call it 70, 80%. And our goal, at least with Endurus, and I think most people's, is to double your money in about 5 to 7 years. That'd be the goal. All right, so let's talk about the top 10. All right, so top 10, first of all, the number one, and this one's, I think, pretty obvious, is you got to invest in the sponsor before the deal. You have to know who you're putting your money with, and that's super important. Whether you're going to get into any kind of partnership, you have to understand who you are partnering with. And great sponsors, great owners can navigate mediocre deals. Now, nobody can navigate a terrible deal. It's just you might be able to navigate it enough to make it a okay deal, get over the hurdle. But a mediocre deal, or even a terrible deal, a good sponsor, a great sponsor, is going to do much better than the other people, right? And so you want to make sure you've got a great sponsor that can navigate. When things go bad, how do they react? When things get tough, what are they doing? Are they spending the time necessary at the property? Are they spending the time necessary with the people there? Are they willing to fire and hire? Are they willing to put their own money into the deal? How well are they communicating with you? All that kind of stuff is so important, because I can promise you this: every single owner of real estate or a business will go through tough times. There's never, I doubt it's ever happened where a person is owned or a company is owned, numerous properties, dozens of properties, and they haven't had deals go bad. Uh, and it doesn't mean they go completely bad. It doesn't mean they lose all their money, but deals that don't go as planned. It just doesn't happen. Every time you're going to have a deal, something doesn't go as planned. And so what happens through those bad times? How do they react? Are they transparent through those bad times? It's amazing to me when I hear it, that people are losing money and they don't even know it because the sponsor isn't communicating with them. That's crazy. It's sad, but it happens. So how do they react in bad times? I think is really important. So understanding what their track record is, getting that, making sure, by the way, a track record is really important, but also making sure they have a concrete business plan that really is understandable, that you can go, okay, I get where they're going with this business plan. And I feel like they can achieve this because of their track record and because it's achievable, right? The market allows for it. This property makes sense for it. All that kind of stuff combined allows for this business plan to actually be completed. But the most important part is, do they actually truly have a business plan that was well thought out and backed by data and backed by experience, right? Those are really important things to all factor into each other, because it's really easy to come up with a business plan that's just, well, first of all, just not very well thought out. But second of all, that's something you've never done, or the market is just, it's not achievable. Like, I can go ahead and pick a property in the worst neighborhood and I can do this gorgeous renovation, but I'm going to fail because I picked it in a terrible, terrible neighborhood, right? It doesn't work that way. So it does everything align with that business plan. Then alignment of interests, how are they getting paid? Do they invest in the deal? You want to make sure the sponsor invests in the deal. Then you want to make sure that how they're getting paid is actually going to be beneficial to you and beneficial to them. So what you don't want to see is a ton of front loading, ton of fee loading. You want to see that it's okay to have, in my opinion, to have some fees because you want a motivated sponsor, but you don't want a sponsor that's taking a ton of fees and they don't care if this property wins because they've already made their money. And there's a lot of people, a lot of sponsors that set their deals up like that in the past. I think it's less so today. It does still happen today, but there's a lot of sponsors that set their deals up to where they get this big acquisition fee. They make huge money on the purchase. They make huge money on the asset management fee. They make huge money just on an exit alone. It doesn't matter how much money the property makes. And then if the property makes some money, they get paid. But they don't care that much if it fails because they've got no financial incentive or very little, right? So that's super important. All right. So sponsors number one, for sure, by far. You've got to make sure you can know, like, and trust the sponsor and do your verifications on the sponsor. I think background checks are always, maybe it's not 100% necessary, but I think that's great. And then understanding their transparency and what they're going to provide. I'm actually going to share this, see if I can do my sharing the right way. Let's see. All right, maybe I'm not going to be as slick on this as I thought I was going to be. Can I share that? I share my. Okay, so hopefully you can see this PDF here. So this is an example of one of our updates. And so you want to make sure, I think it's really important if you're talking with somebody, and by the way, if you're doing this yourself, like, you need to make sure you can communicate well with people. So this is what we send every month to our investors. Um, Shoot me a message if you can't see this for some reason, but I think you can. um, so this is what we sent. So we just, obviously, this is like just the property, metrics, what we bought them for, and all that kind of stuff. This doesn't change. The loan amount will change, but um, that's pretty much everything doesn't change. Then we send just an update, what's going on, where our rents are at, um, leases, pre-lease, occupancy, all that kind of stuff. And this portfolio, we've got two properties. We've increased the rents significantly, and so we talk about that. Um, Occupancy, we're renovating units, so we're 87.5% occupied on both of these, which is actually a good thing. That's where we want to be. Oh shoot, I'm not seeing it. All right, all right, all right. Let me, come on. Sharing. Okay. How do I share? All right. Why is it not? Here we go. Okay. I think we got it now. Okay. I think we're good. So now I just got to get this silly little thing out of here. All right. So, you know, the, I'll go back to here. This is where it starts, right? We just have the statistics of the property, and what we purchased for, what it is, when we acquired it, what our renovation budget is. So that way investors just a fresh reminder, especially some investors that are investing in a lot of different stuff. I think that's super important. And then we talk about just kind of what's going on, just a summary of what's happening, a narrative. We've got our executive summary, which talks about what our NOI is, what our occupancy is. These are being renovated, so occupancy is always going to be a little bit low. This is exactly where we want it, but we're highly leased. When we talk about kind of what's going on with leasing, with operations, with site visit, this is actually something, quite frankly, like almost all of this that I have that we send out every month is investors going, "Hey, I would love to see this added to your investor reporting. Do you think you could do this with your investor reporting?" And so we've done that, and we've actually created a much more robust investor report, where we look at what's our current performance, what's our budget, what's total revenue versus budget, how much are we over, what's our variance, like our NOI is 12.9% over our budget. Um, and that we show kind of what's going on there. And then we talk about our capital improvements, give us, what are we doing? Where are we going? Right. And then, of course, some pictures. And then here's one thing. This is another investor like request that I got. I never used to do this, but I love it. I love it when investors are like, "Hey, what do you think about adding this?" Sometimes it makes sense. Sometimes it doesn't, but if I can add it, man, that's great. So here we talk about how much we are over budget in this case, or if we're below budget, we talk about how much we're below budget. Of course, if we're below budget, we're typically talking about what can we get better at? How can we get to budget? What are we working on to get to budget? But we can show that, hey, this is where we budgeted, the blue line, this is where we're at. Expenses, of course, below budget would be good. And then NOI, how are we, why are we above budget? How far? DSCR, debt service coverage ratio, like where are we at? We're very healthy, right? And then we give some market commentary, what's going on in the cities that this is located in, what's going on in the overall rent market. And that's kind of it, right? Just a brief, well, we send this out every month. So I think it's super important to ask if you're going to be a passive investor, go, hey, what's going on with this? How do you communicate? How often do you communicate? How do you communicate? It's super important to know that. I want to make sure I get what's going on, right? So, all right. All right, let's move on. Underwrite the downside, not the upside. I think this is super valuable. If you underwrite the downside and not the upside, that's going to give you a lot better understanding of where this property could go wrong versus if we just underwrite the upside. Quite frankly, I would avoid investing in a deal that only underwrites the upside because that means that they're not thinking about what could go wrong, or at least they're not telling you they're thinking about that. They're not communicating that to me. So I want to make sure we actually understand what some of the downsides are, not the upside. I'm much more concerned about protecting my capital than I am about making money. I don't get me wrong, I'm not investing to just let it sit there. I really do want to make money, but I want to make sure that the downside has been thought about. And again, it can happen. Certainly it can happen. But what happens if rents are flat? What happens if they're negative, right? What happens if occupancy drops and we can't get our occupancy where it is? Look, a lot of markets right now have terrible occupancy. A lot of the southeast, like Charlotte, Dallas, Phoenix, Austin, San Antonio, Atlanta, like the list goes on. These markets have a ton of deliveries. Now, some of them are improving, some of them aren't yet. But what happens when my occupancy and rents drop? What happens if refinancing isn't available? How much pain really can this deal absorb? And I'll show you that in a second. Now, we can't ever predict everything, right? But we have to make sure we have enough data to say we like what we see here. So we provide this for our investors, and this is just a few things that we want to go through. We have multitude of other things, but this is like, hey, what are our risk factors? So what if we have a change in bad debt and concessions? And what if we have a change in occupancy? So if our occupancy, you can see if our occupancy is at 87% and our bad debt and concessions are at, let's call it 5%, which is pretty big. And this isn't vacancy. So vacancy is outside of this picture that we have another one for vacancy. The return on investment to investors is 4.23% on an annualized basis. This is year one. We show different scales for different years, but so investors are making some money. Okay, not great, but you're still making a few bucks. What happens if we get a ton of occupancy and we've got, great bad debt and concessions? Okay, here's what it looks like. So you can see your sliding scale of what, you can kind of make it. I think as an investor, if you're going to be buying your own properties and you're going to be running your own properties, it's really important to do this as well. Like, you got to make sure you have some cushion. What happens if things don't go right? Because they won't. Here's the change in exit cap. So we project out to the future what this property will sell for, but we're never going to be right? We don't know exactly what the exit cap is going to be. We don't know exactly where the rents are going to land. But what happens if rent growth is slower or faster? And what happens if cap rates are, greater, higher, or lower? So, look, if the cap rates are at 5.5 and the rent growth is at 3% annualized on average, we make about 17.7% IRR. But what happens if it's not great, right? What happens if we don't have much rent growth? And what happens if the cap rate continues to expand? Cap rates have expanded a ton because of interest rates. So cap rates, look, if 4 years ago, if I bought a property in 2022 for call it a 5 cap, that market is likely now at a 5.5 to 6 cap, maybe even higher, depending on the market. And so, what would I sell that property at today? Like, if I bought it at a 5 cap and I had to sell it at a 6 cap, you can see how much value you lose. How much this is percentage to investors in IRR. Um, so kind of gives you an idea. And what you want to see is, are you still making some money? Like, maybe it's not a home run, but are you still doing okay? And then you go, okay, well, what's the real reality? Like, if I'm looking at this, like, okay, what's the reality from going to a 5.5 cap to a 6.25? Yeah, that could happen, right? What happens if, rent growth is only 1.5%? Okay, well, yeah, that could happen. So am I okay with a 10% IRR, or is that something I'm going, no way, zero chance? I don't want, even if it goes bad, I just don't want that, right? So you got to decide what's right for you. This to me is extremely valuable. I think this is one of the most important slides to understand that you need to know where your break even is for as far as occupancy. When does this property start bleeding cash? And the lower this number is, the better. So if our break even occupancy is at 61%, that's a really healthy property, right? If our break even is at 75%, ooh, we're starting to get a little more risk. If it's at 80%, like, that's a high risk deal. 90%, holy cow, like, forget it. That deal doesn't work ever. Right. So we got to understand where our break even occupancy is. And again, the lower that number, the better it is for you. So I think that's super important. All right. This kind of goes along with the last slide, but preserving capital first, making money second is super important. The main goal of investing is not to maximize returns, but to avoid losing capital. That's the first goal. The second goal is to make good money. Um, I think it's super important to understand your goals and objectives as an investor, passive or active, and understand what you're truly looking for. So I was just talking to somebody, and this happens a lot. I was talking to somebody the other day. They want cash flow. They want properties that cash flow well. They're not as concerned with the IRR. They're not as concerned about the exit. They think if you've got a strong cash flowing property that operates well, it's a win. No matter what, it mitigates their risk because they're getting a good return on their capital, and likely it'll sell for a good profit in the end, and they'll win really pretty well, right? They're less excited about a deal that actually doesn't have much capital but has a lot of upside, cash flow, but has a lot of upside, because they're like, hey, that's just a lot of risk and we don't know exactly what's going to go on in the future. Okay, great. That's one way of thinking of it. Other people like the deal that has high risk but high potential, and that's okay. But I think it's so important that you understand your goal and objective of investing in this property and what you actually want to achieve, and stick to that, because so many people don't. I have all these conversations with these people that are like, oh, I want cash flow. And then I send them a deal. It's got great cash flow. It's got, awesome fixed rate debt. And they're like, no, that's not exciting. I'm investing in this deal. And that deal's bridge debt. It's got no cash flow. And it's like, okay, that's fine. Doesn't bother me, but are you sure those are hitting your goals? So, look, a deal with low IRR, low projections isn't necessarily better or worse. Isn't necessarily worse than a deal with the high projections. Quite frankly, the deal with the high projections is probably gonna not hit those projections more often than not. So, um, this is, I think, a huge deal, and this is what killed a lot of both active investors and passive investors over the last handful of years, is that debt kills deals. So debt can make or break deals. And most of you understand this if you've been in the game, is that a lot of people, and these are very experienced operators, by the way, um, have lost properties or have had to do big capital calls because they had poor debt. And most of it was because of the poor debt. There was might have been some operational challenges and some of them might not have been, but most of it snowballed because of the debt. And if they had better debt, the deal maybe wouldn't have been the best deal in the world, but it would have been okay. And so I think that's so important to understand that. And that adds another layer of risk to the deal. So if you like risk, you know, you maybe don't care about debt. But if you want to mitigate your risk, this is a big one, in my opinion. Um, Fixed rate versus floating rate debt. I mean, floating rate debt is going to be your highest risk, definitely. Loans with quick maturity dates, definitely higher risk, right? Can we extend that loan or not? Extensions are expensive. Usually you have to pay for them in a significant amount of money. So even if you can, that costs money. And then the other thing that people get messed up with is the debt service coverage ratio. It's really tight. So meaning like my net operating income is almost the same amount as my debt service. So I just don't have a lot of cushion at the end of the month. I'm barely making it. My margin is so small. I want as high of debt service as I can. I want to be in that 1.5 to 2 debt service if I can, because that gives me cushion. That means things can go wrong and I'm still okay. And then what's my chance of being able to sell or refinance this thing? So one of the things with the loans that a lot of people got in trouble with, these bridge loans. They're typically 2 to 3 year terms, and then they have like 1 to 2 years of extensions on top of them. And again, those extensions are expensive. They're not guaranteed. You're not guaranteed to have an extension. The lender can say no, or change things on you, and the rates can move quickly. And so a lot of people saw rates go from 3.5% to 9% over a very short period of time. Like we're talking like a year, right? 3 to 4% to 9% in like a year, and they're just totally screwed, and there's nothing they can do about it. Now you can buy a rate cap, so I guess there is something you can do about it. But the rate cap, can cost 6 figures at the minimum, all the way up, 7 figures. So you might spend $500,000 or more on a rate cap, and that's basically prepaid interest. That's all it is. You're spending $500,000 to cap your interest rate to stop that cash flow bleed, but you had to spend $500,000 to get maybe at the most, if you're lucky, $500,000 worth of value. So it's an insurance policy essentially, and that's a high amount of risk. So I don't love bridge debt. You got to decide what you want to do, and I don't love a bunch of debt stacked on top of debt either. So a lot of people were getting bridge debt with mezz debt stacked on top of it, or getting pref stacked on top of it. So now you, as an investor, are like in third place, maybe even fourth place. Man, everybody's got to get paid until you get paid. That's a risky situation. So just be aware of how the financing is structured. Is it fixed debt? Are you the second behind the debt? What's the loan to value on this thing? What's the debt service coverage ratio? To me, debt service is way more important than loan to value, but both are important. All right. Understand how the sponsor gets paid. Look, I'll just run through it real quick. Sponsors are typically paid an acquisition type fee somewhere between, I put 2 to 3%, but as low as 1% to, I would say as high as 3%. Then there's asset management fees, usually on the revenues, pay an asset manager. I mean, we have a person that works for us full time, that he's making sure everything with the property is running right. So he's asset managing that property. And even the properties we run in-house, he's still making sure that in-house we're doing it right. Our books are done, they're done properly. He's looking for extra things when he goes through the financials. He's looking, okay, whoa, the sewer bill, water bill is too high this month. What's happening? What can we do here? Why is the occupancy dropping? What are we doing here? Hey, we got a bunch of renewals happening. Have we sent out notices on the renewals? All those, he's the checks and balances of everything that's going on with operations. So that's the asset manager. And then refinance fees. I mean, sometimes people charge for a refinance or for a disposition. I don't like big fees on those. Refinance, maybe a small fee at the very most, but 0 to 1%. Construction management, if you're in house, probably going to charge 5% fee. If it's not in house, probably shouldn't be charging much, depending on what they're doing for management, if any. Same thing with disposition fees. I don't like disposition fees. I think they're garbage fees, but maybe 1% at the most if you're okay with paying them. And then the promote, what's that look like? So you want to make sure you're getting paid first. So the more fees there are here layered on, like if I got a 3% acquisition fee, if I've got a 3% asset management fee, if I've got a refinance fee, if I've got a disposition fee, if I've got a construction management fee, and they're all big, and then we get to the promote, what's there left? Like there might not be anything left. So you might be getting nothing, by the way. So the promote doesn't matter if it's all fee heavy. So make sure it's not too fee heavy. And if you're offering these types of deals, you got to get paid. You want to get paid, but set it up to your investors have the incentive. They get paid first, you get paid second, because you should get paid based on your results. Um, so 70-30, 80-20, maybe there's some sort of hurdles in there. That's great. But to me, the sponsor should only become wealthy when the investors become wealthy. So if you have poor investors and you're a rich sponsor, uh, you're doing things backwards. You should have rich investors and rich sponsors. We want them both together. That's a win. That's a recipe for investors coming back when they're doing really well. You're doing really well. That's a great win. So that's what I want. That's our goal for every deal, and I think that's most sponsors' goals. Um, Maybe not all, but most definitely. All right, know the risk. I think this one's really important. I think this is often overlooked is understand the risks that goes on in that property and that's going to go on in that neighborhood. So what's going on in the neighborhood? What kind of crime, what kind of jobs, what kind of growth is happening? What's the average age of the resident in that area? Who's moving in and who's moving out? I think are really, really important. So there's crime maps that you can find for free online. You can pay subscriptions if you want to get a little bit more detail. And same with jobs and growth maps and all that kind of stuff. And really understand what's happening in that neighborhood. I think is super important. Now, hopefully the sponsor has that for you. This is the other thing. A lot of this as we look at is like if you're not the actual investor and you got sponsors that you're passive investing in, they should have this stuff for you. They should understand what kind of job growth is happening and all that kind of stuff. Um, renovations are big, and a lot of people discount like the bigger the renovation, the more the risk. That's just it. And the more the opportunity, hopefully. So you have to make sure if the renovations are big and we're going to have some vacancies and we're going to have some low cash flow in the first couple of years, like what am I getting in return for that? If I've got a bunch of renovations but I've got no potential upside to that or not a lot, like is that really worth the risk, or should I just invest in that deal that's pretty stable that maybe has some paint and flooring to do and that's it, right? And the return risk is just way less. So understand, what's going on with those renovations, how big are they, and how much opportunity do they actually provide to that investment. Um, Rent growth assumptions, man, I see it. This is crazy to me. This is still happening today, and I see these sponsors putting deals out there, and let's call it a deal in the southeast, right? And right now, rent growth is actually negative. So we're talking like -3, -4%. And they're putting a deal out there, and they are going, "Hey guys, year one we're gonna see 3% rent growth. In year two, we're gonna see 3%, 4%, 3% every single year, right? Or maybe it's even 0% year one, 2%, 3%. But look, if you're so far off already, If the rent growth is negative 3% and you're showing even 0% in year one, you're telling me that that city is going to go from -3 to 0 in 1 year. It's going to have a three. That does it happen? Can it happen? Sure. Does it happen often? Very rarely. The economy would have to switch quickly. Like so many things would have to go right for that to happen. It's just not realistic, especially that -3 to 3. I've seen that, by the way, by sponsors putting these crazy pro formas out there, and it seems conservative because 3% rent growth just seems okay, right? That's no big deal. But man, if it's -3 and you're going 3, no, there's no chance. Sorry, you're already so far off. That 16 IRR now became a 10 IRR, and that's with no other risk added to it. So understand what's actually happening in the market as far as rents, as far as occupancy goes, all that kind of stuff. What's truly happening in that market? Um, Reserve accounts. This is another thing. It's easy to boost IRR and boost what we're getting if we don't have much money set aside. I want to make sure we got plenty of money, slush money, right? We want to make sure we can cover debt service when we get in trouble, like 6 months or more. We have renovation reserves, like 10% or more, right? We want to make sure that is happening. Property and asset management. I think for us, in-house has been huge. We used to do third party on everything, and we brought almost all of our property management in-house. We were able to raise our average um, occupancy by about 6%. Our NOI grew by 44% over a very short period of time. We're talking like a year. Those things happen. And I think if you are investing in a sponsor that has property management in-house and has a good track record, that's going to be a better bet than if you're investing in a sponsor that's using third-party property management. I don't think there. I haven't met many good third-party property management companies in the apartment world. I have in the retail space and some of that space, but in the apartment world, I just haven't met. I don't think I've met any. I mean, we've hired and fired a ton of them, and it's just a revolving door. So I think if you can handle property management, that's the best way to go. And then, of course, I already talked about the capital stack, so I'll understand that. Um, the last risk is the exit risk. Who's going to buy this asset in 3 to 7 years? A lot of people invest think, well, man, what a great purchase price. I've thought about this before too. Like, what a great purchase price. I'm buying this for so cheap, but who's going to buy it from me for more money? That's the question you should be asking. Look, if you buy in a bad neighborhood, you can buy it for cheap. It's great. I bought a 20 unit building for super cheap in a bad neighborhood. Um, who wants to buy that from me? And are they going to really pay top dollar for that thing? No way. So I ended up selling it, and somebody bought it for more than I paid, but I didn't make much money on it because nobody wants to pay a lot of money. Everybody wants a discount in a bad neighborhood. So understand what you're buying. Same thing if it's an obsolete building, like if the weird layouts, weird floor plans, just weird. I think about a single family house. If it's got the tuck under a garage, it's got just goofy layouts. Like some of those things you just can't change. Nobody wants it. And so that property sits there forever. Nobody buys it. So who's going to buy this thing, and what's going to happen to this asset in 3 to 7 years? Is the neighborhood going up, or is the neighborhood going down? Right? Is the occupancy in the market going up, or is it going down? Right? What's going on in the overall demographics? And then, does the deal only work if cap rates or interest rates fall? Like, that's speculating. We're not really investing. And I'm seeing that today. It's like, we're going to buy this. Interest rates are high today, but in 5 years, interest rates are certainly going down. Well, guess what? Interest rates aren't going down right now. Will they go down in another 5 years? Maybe. I don't know. If you know that, please let me know, because I have no clue. If you are a passive investor, I think it's really important to diversify across sponsors and markets. Look, if you're one of my passive investors and you're listening to this, I think it's a smart move. Do I want you to invest in every single one of my deals? That'd be great, right? But I want you to also be diversified across different sponsors and different markets because I think that even great operators can make mistakes. Even great operators will experience difficult deals. And I think that's really important to diversify geographically. I think it's important to diversify with a couple different sponsors. Now, I don't think it's smart, by the way. I don't think it's smart and if you're active, I don't, same thing. I don't think it's smart to be partnering with a bunch of different people. I think it's really, really valuable and much more important to partner with maybe call it 2 to 4. Maybe you can hit 5. Maybe that makes sense. But I think you've got to get to know the sponsors really well. You have to understand their philosophies and make sure it matches with you. You got to go through all these steps. So I think it's going to take too much time and energy to do it right and to have 10, 15, 20, 30 different deals with 30 different sponsors. I think you're going to actually do worse doing that than if you have, call it 3 different sponsors that are investing in different locations, maybe have slightly different business plans, slightly different philosophies. I think that is going to be a winning recipe versus just trying to spread your money out to everybody and not really truly getting an understanding of what's going on. But I also think it's good to get with a couple different sponsors, not just one. So vintage years, all that kind of stuff. And asset classes, quite frankly, I think that's a good one too. I mean, you look if I love multifamily. We invest a lot of multifamily, but look, we also have a retail deal that's doing amazing, right? We have an industrial deal that's doing really good. Like we have other deals, assisted living. We have, one of our assisted livings that are doing amazing, right? So we have different asset classes that we have sponsored, but I think it's super important to try to diversify as much as you can with also understanding what you're diversifying into. Again, have realistic expectations. The worst call that I get is from the investor that's like, "Hey, I got this going on. Can I get my money back out?" And these are illiquid investments. Now we do our best to try to achieve that for that investor if they need their money back. And it hasn't happened to us very often, but a few times somebody's like, "Hey, I've got this life event. I need my money back. What can you do for us?" And again, we try to do our best and get their money back, but it's an illiquid investment. So understand that it's illiquid, it's cycle, it's imperfect. It's not a stock. And then also some deals outperform, some deals underperform. So that's the importance of diversifying. Last one, FOMO. Don't invest just because you're fearing you're missing out, but don't wait also to invest because of fear. Like the fastest way to make a bad investment is believing that you're going to miss out. Yeah, these sponsors, and I'm probably guilty of it too, right? Like, this is your last chance. We only have a few spots left. We're 90%. I know I'm guilty of this because I do it because I want people to get in, like if they want to get in, but I also don't want people to rush into a bad decision. If it's not going to work for you, don't invest with it. And so I don't do it to like get to trick investors. I do it to make investors aware. But yeah, we're 90% full. We're invest today. Look, if this isn't the right deal for you, slow down and just be patient. Like find the right deal for you. Don't get caught in that. But also don't get caught in never doing something. And I see that as well. I see people that talk to me, they're all excited, they want to do something, and then they just keep on waiting and waiting and waiting. I had a conversation the other day with a guy. We sat down for lunch and he's like, "Man, there's been so many of your deals that I've just wanted to do, and I did the one, and I haven't done the next one, and I just kick myself for not doing some of those deals." And it's like, well, it's like you fear and you make yourself so nervous about it, and then you don't push the trigger going forward, and you miss out on a lot of opportunities. Now, it doesn't mean that you need to go for every opportunity. You got to go for the right ones that fit you and fit what you're looking for, but don't just keep on kicking that can down the road and never investing. I do see people that do that. And I see it probably more often with actually active investors that like, I can think of one person right now. Like he goes to every course, he's done tons of conferences. He's the most educated person you'll ever know on this real estate stuff, but he never invests in anything, never buys anything because he's got that fear gripping him and he doesn't want to make a mistake.